What is a maintenance call? Have you ever wondered what happens when your investment account dips below a certain level? Let's talk about maintenance calls and how they fit into margin requirements, especially in options trading. A maintenance call is a request from your broker for you to add more funds or securities to your margin account. This occurs when the value of your account falls below a minimum level known as the maintenance margin. The maintenance margin is the least amount of equity you need to keep in your margin account after purchasing securities with borrowed money. When you trade using margin, you are essentially borrowing money from your broker to buy more securities than you could with just your own cash. While this can boost your potential profits, it also raises your risk. If the value of your investments decreases, your equity, calculated as the value of your securities minus any borrowed amounts, could drop below the maintenance margin requirement. So, what happens next? If your equity falls short, your broker will issue a maintenance call. You will then need to deposit additional money or securities into your account, or you might have to sell some of your positions to restore your account to the required level. If you do not meet the maintenance call by the deadline set by your broker, they may sell some of your securities to cover the shortfall. In the context of options trading, understanding margin requirements and maintenance calls is particularly important. Options can be quite volatile, and their prices can shift rapidly. This volatility increases the likelihood of receiving a maintenance call for traders who use margin. To manage this risk, many traders set profit targets and stop-loss orders while closely monitoring their account equity. Let's consider a practical example. Imagine you purchase $20,000 worth of stock using $10,000 of your own funds and $10,000 borrowed from your broker. If the stock price drops and your investment value falls to $14,000, your equity is now $4,000, assuming you still owe $10,000. If your broker has a maintenance margin requirement of 30%, you would need to maintain at least $4,000 to $100 in equity. Since you only have $4,000, you would receive a maintenance call $400 to $100. Understanding maintenance calls is essential for anyone trading stocks or options on margin. It helps you manage risk and avoid unexpected losses. Always check your broker's specific requirements, as they can vary and may be higher than the minimum set by regulators. Being proactive and informed can make a significant difference in your trading experience.